David Lowenstein, VP of Investor Relations. Please go ahead.
Thank you, Madison. Good morning, everyone, and thank you for joining our Fiscal 2025 fourth quarter earnings conference call. I'm here today with Bill Nash, our President and CEO, Enrique Mayor-Mora, our Executive Vice President and CFO, and John Daniels, our Executive Vice President, CarMax Auto Finance Operations. Let me remind you, our statements today that are not statements of historical fact, including but not limited to statements regarding the company's future business plans, prospects, and financial performance, are forward-looking statements we make pursuant to the safe harbor provisions of the Private Securities Litigation Reform Act of 1995. These statements are based on our current knowledge, expectations, and assumptions, and are subject to substantial risks and uncertainties that could cause actual results to differ materially from our expectations. In providing projections and other forward-looking statements, we disclaim any intent or obligation to update them. For additional information on important factors and risks that could affect these expectations, please see our Form 8-K filed with the SEC this morning, our annual report on Form 10-K for fiscal year 2024, and our quarterly reports on Form 10-Q previously filed with the SEC. Should you have any follow-up questions after the call, please feel free to contact our Investor Relations Department at 804-747-0422, extension 7865. Lastly, let me thank you in advance for asking only one question and getting back in the queue for more follow-ups. Bill?
Great. Thank you, David. Good morning, everyone, and thanks for joining us. We're very pleased with the continuing momentum across our diversified business during the fourth quarter. Our results reflect solid execution and the strength of our business model. We delivered robust year-over-year EPS growth as we drove unit volume increases in sales and buys, materially increased gross profit, grew CAF income, and realized additional cost efficiencies. Our associates, stores, technology, and digital capabilities, all seamlessly tied together, enable us to provide the most customer-centric car buying and selling experience. This is a key differentiator that gives us the right to win and access to the largest total addressable market in the used car space. This also positions us to drive sales, gain market share, and deliver significant year-over-year earnings growth for years to come. In the fourth quarter, on a year-over-year basis, we grew retail and wholesale unit volume. We delivered strong retail, wholesale, and EPP GPUs and materially improved service gross profit. We bought more vehicles from both consumers and dealers, achieving an all-time record with dealers. We grew CAF's net interest margin and continued to advance our full credit spectrum underwriting model. We materially leveraged SG&A as a percent of gross profit, and we also achieved double-digit EPS growth for the third consecutive quarter. For the fourth quarter of FY25, we delivered total sales of $6 billion, up 7% compared to last year, primarily driven by higher volume. In our retail business, total unit sales increased 6.2%, and used unit comps were up 5.1%, despite having one less selling day, inclement weather, and a delayed start to this year's tax season. Average selling price was in line with last year's fourth quarter. For the full year, total retail unit sales increased 3.1%, and used unit comps were up 2.2%, with a decline in the first quarter more than offset by gains across the second, third, and fourth quarters. Our market share data indicates that our nationwide share of age 0 to 10-year-old used vehicles was 3.7% in calendar 2024, consistent with 2023. External title data shows year-over-year, while our share came under pressure during the first half of 2024, it then recovered as we achieved accelerating gains through the second half, with particular strength in age 0 to 4 vehicles, which grew for the entire year. The data indicates that our market share continued to grow year-over-year during January 2025, the latest period for which information is available. While I do not intend to provide another update until this time next year, we remain confident in our ability to achieve further market share gains and across 2025 and beyond. Fourth quarter retail gross profit per used unit was $2,322, a fourth quarter record up from last year's $2,251. Wholesale unit sales were up 3.1% versus the fourth quarter last year. Average selling price was flat year-over-year. Fourth quarter wholesale gross profit per unit was $1,045, which is historically strong, though down from the $1,120 a year ago. We bought approximately 269,000 vehicles during the quarter, up 15% from last year. We purchased approximately 223,000 vehicles from consumers, with more than half of those buys coming through our online instant appraisal experience. With the support of our Edmunds sales team, we sourced the remaining approximately 46,000 vehicles through dealers, which is up 114% from last year. For the fourth quarter, approximately 15% of retail unit sales were online, up from 14% last year. Total revenue from online transactions was approximately 29% compared with 30% last year. All of our wholesale auctions and sales were virtual and are considered online transactions, which represented 17% of the total revenue for the quarter. Approximately 58% of retail unit sales were omni sales for this quarter, up from 55% in the prior year. As a reminder, our omni-channel sales definition incorporates customers who complete some, but not all, of the following transactional activities online: reserving the vehicle, financing the vehicle if needed, trading in or opting out of a trade-in, and creating a sales order. To better reflect the ways customers are utilizing our digital capabilities to buy a car, going forward, we are updating our definition of an omni-channel sale to also include customers who complete any of the following steps online: pre-qualifying for financing, setting appointments, and signing up for notification on cars coming soon. Based on this updated definition, approximately 67% of our retail unit sales were omni this quarter, up from 64% last year. Of note, this does not impact how we calculate online sales, since the steps to complete an online retail transaction remain the same. Across omni and online, our digital capabilities supported over 80% of our sales during the fourth quarter. We expect that our mix of digitally supported sales will continue to grow over time as we add further enhancements to our online tools, customers become more accustomed to leveraging them, and as we improve our ability to track their use. Turning to finance, CarMax Auto Finance, or CAF, delivered income of $159 million, up 8% from the same quarter last year. In a few moments, John will provide more detail on customer financing, the loan loss provision, and CAF contribution, as well as our progress on full credit spectrum lending and increasing CAF's penetration. At this point, I'd like to turn the call over to Enrique, who will share more information on our fourth quarter financial performance. Enrique?
Thanks, Bill, and good morning, everyone. The momentum we built over the last few quarters continued into the fourth quarter. We achieved positive growth in retail and wholesale units, increased per unit and total dollar margin, grew CAF income, and had strong flow-through to our bottom line. Fourth quarter net earnings per diluted share was 58 cents, up 81% versus a year ago. Adjusted for a $12 million non-cash impairment within other expense related to an Edmunds lease, EPS was 64 cents, which is doubled from a year ago. Total gross profit was $668 million, up 14% from last year's fourth quarter. Used retail margin of $424 million increased by 9%, with higher volume and per unit margins. Wholesale vehicle margin of $125 million declined by 4%, with an increase in volume offset by a reduction in per unit margins. Other gross profit was $119 million, up 72% from a year ago. This was driven primarily by a combination of EPP and service. EPP increased by $8 million, or $10 per retail unit, as we lapped over the initial rollout of margin increases that took place in last year's fourth quarter. Service recorded a $1 million loss, which was a $44 million improvement over last year's fourth quarter. We achieved this performance improvement through successful cost coverage, efficiency measures, and growth in sales. On the SG&A front, expenses for the fourth quarter were $611 million, up 5% or $30 million from the prior year. SG&A leveraged by 770 basis points, driven by growth in gross profit and our ongoing actions to improve expense efficiency. SG&A dollars for the fourth quarter versus last year were mainly impacted by two factors. First, total compensation and benefits increased by $22 million. Over half of this increase was due to our corporate bonus accrual, with the majority of the balance driven by unit volume growth. Second, advertising was up by $9 million due to timing. This was in line with the guidance we provided last quarter. In respect to capital allocation, during the fourth quarter, we repurchased approximately 1.2 million shares for a total spend of $99 million. As of the end of the quarter, we had approximately $1.94 billion of repurchase authorization remaining. As we look ahead, I'll highlight a few key areas which support our earnings model that Bill will speak to shortly. We are testing EPP product enhancements that will focus on increasing penetration and per unit margins. These enhancements are expected to drive a small year-over-year increase in per unit EPP margin in FY26, with the potential for more expansion in fiscal 27. We expect service margin in FY26 to grow year over year, predominantly in the first half of the year, and to deliver a slight positive profit contribution for the full year, as governed by sales performance given the deleverage nature of service. Additionally, we expect service to continue to serve as a slight profit lever beyond FY26. In respect to SG&A, in the nearer term, we expect to require low single-digit gross profit growth to lever on an annual basis, including in FY26. This will be supported by our goal of hitting full-year omni-cost neutrality in FY26 for the first time, with continued improvement thereafter. We expect all three metrics, per used unit, per total units, and as a percent of gross profit, to be more efficient than pre-omni for the full year. This reinforces our pathway back to a lower SG&A leverage ratio, with the initial goal of returning to the mid-70% range over time as we see healthier consumer demand. In FY26, we expect that marketing spend will be approximately the same as in FY25 on a total unit basis. With regard to capital expenditures, we anticipate approximately $575 million in FY26. The increase is primarily driven by the timing of land purchases as we experience favorability to our FY25 outlook due to the timing of certain deal closures. Similar to FY24 and FY25, the largest portion of our CapEx investment is related to the land and build-out of facilities for long-term growth capacity in off-site reconditioning and auctions. In FY26, we plan to open 6 new store locations, up from 5 in FY25, and 4 standalone reconditioning and auction centers, up from 2 in FY25. Our extensive nationwide footprint and logistics network continue to be a competitive advantage for CarMax. Now I'd like to turn the call over to John.
Thanks, Enrique, and good morning, everyone. During the fourth quarter, CarMax Auto Finance originated approximately $1.9 billion, resulting in sales penetration of 42.3% net of 3-day payoffs, which was in line with last year's fourth quarter. The weighted average contract rate charged to new customers was 11.1%, a decrease of 40 basis points from a year ago, which was reflective of credit tightening and APR reductions executed prior to Q4. Third-party Tier 2 penetration in the quarter was 17.6% of sales, down 110 basis points from last year, while third-party Tier 3 volume accounted for 7.9% of sales, down 30 basis points from last year. CAF income for the quarter was $159 million, which was up $12 million from FY24. This increase was driven by net interest margin, which remained steady from the third quarter at 6.2%, but is up 30 basis points from last year's fourth quarter. Provision for loan losses was $68 million and results in a total reserve balance of $459 million, or 2.61% of managed receivables. This sequential improvement in the reserve to receivable ratio reflects an additional quarter with a more normalized provision, along with the continuation of previous credit tightening. Regarding our full spectrum lending initiative, we remain excited about CAF's continued efforts in this space, as well as the tremendous growth potential unlocked by the broadening of our securitization program. During the month of March, CAF began measured expansion by recapturing profitable portions of Tier 1 originations that we had shifted to our Tier 2 lenders as we tightened lending standards. This adjustment is targeted to grow our penetration by 100 to 150 basis points in the near term and is enabled by our non-prime securitization program, which allows us to efficiently fund these non-prime receivables while retaining the full economic value of the contracts. We were also pleased to successfully execute our second non-prime ABS transaction, which closed in late March and was well received in the market. We continue to learn from our new underwriting models and corresponding tests currently in place and anticipate capturing additional volume across Tier 2 and Tier 3 during the back half of the fiscal year. But as always, we will carefully monitor the consumer and the broader economy and will adjust our origination strategy as needed. It is worth noting that in the first quarter, we are forecasted to have a larger provision sequentially and year over year, driven by new origination volume. This stems from seasonally higher sales and a lower credit quality period, plus the need for additional reserve given the profitable but higher loss nature of the recaptured receivables that I mentioned a few moments ago. As a reminder, we expect this initial impact from building the loss reserve as we grow CAP penetration to be materially offset by future income over time. Now I'll turn the call back over to Bill.
Thank you, John and Enrique. As I mentioned at the start of the call, I'm pleased with the momentum we are seeing across our business. The associate and customer-facing tools we launched during fiscal 25 are contributing to our results and to providing the most customer-centric car buying and selling experience. I'm proud of the steps we took during the year to further differentiate our offering and drive incremental operational efficiencies. Some examples include, for retail, we rolled out a number of new systems that enhance consumer shopping experiences, support conversion, and enable our associates to be more efficient. These include order processing in our stores, customer accounts online, AI-driven knowledge management in our CECs, and EV research and shopping tools on the Edmunds and CarMax websites. Our digital tools and enhancements have made it easier for consumers to self-progress in their shopping journey. Sky, our AI-powered virtual assistant, is now able to independently answer over half of the questions our customers ask it, reflecting more than a 20% year-over-year improvement. Additionally, the rate of fully self-progressed online sales grew by 25% across fiscal 2025. For supply, we enhanced both our consumer and dealer-facing appraisal experiences. We are now able to give digital offers to approximately 99% of the customers who come to CarMax.com for an appraisal, and we made Max Offer even easier to use. This has attracted more dealers to the offering and has driven strong record sourcing volume each quarter. For finance, we began testing new credit scoring models and corresponding strategies across the full credit spectrum, which positions us to further grow CAP income modestly in the near term and more materially over time. We also released an update to our finance-based shopping experience that seamlessly incorporates existing instant appraisal offers into our pre-qualification offering, giving customers more precise credit terms. And finally, we continue to focus on driving down cost of goods sold by pursuing incremental efficiency opportunities across our logistics network and reconditioning operations. We achieved savings of approximately $125 per unit this year and anticipate that we will achieve at least another $125 per unit in fiscal 2026. This exceeds the initial $200 target we set at the beginning of fiscal 2025. These efficiencies support affordability as we pass savings on to our customers and also support our margins. In fiscal 2026, we will leverage and enhance our capabilities to drive growth through better execution, innovative offers, innovative efforts, and up-leveled experiences. Some examples include, for retail, we will continue leveraging data science and AI to offer even better digital experiences for our associates and consumers, driving conversion and efficiency. We plan to improve our online vehicle transfer experience and to expand Sky's functionality with additional data and new architecture. In recognition of the breadth and seamlessness of our best-in-class offering, we will also launch a new marketing campaign over the summer that will bring our omnichannel experience and our digital capabilities to the forefront for a broad set of consumers. For supply, we plan to streamline the online appraisal checkout process and expand appraisal pickup availability to new markets. We will also further enhance Max Offer to attract new dealers, expanding our access to directly sourced vehicles. For credit, as John mentioned, we plan to continue expanding CAP's participation across the credit spectrum to grow penetration and capture profitable returns. Additionally, we plan to modernize the ownership experience on CAP's digital platform, which will enhance customer experience and drive operating efficiencies. Looking ahead, we've positioned the company to achieve ongoing growth in retail and wholesale unit sales and market share with double-digit EPS growth for years to come. We're excited about the power of the earning model we have built. Our model is designed to deliver an earnings per share growth CAGR in the high teens when retail unit growth is in the mid-single digits. In addition to retail and wholesale unit growth, other key inputs driving our model are strength in other gross profit, CAP's credit spectrum expansion, continued operating efficiencies, SG&A leverage, and our share repurchase program. Regarding our long-term goals, We are focused on growing the business, and we continue to make progress towards those goals. However, at this point, we are moving the timeframes associated with them given the potential impact of broader macro factors. Before turning to Q&A, I want to recognize two significant milestones. First, Fortune magazine recently named CarMax as one of its 100 best companies to work for the 21st year in a row. I am incredibly proud of this recognition. It's due to our associates' commitment to supporting each other, our customers, and our communities every day. Second, we opened up our 250th store during the fourth quarter. Reaching 250 stores across the country is a fantastic accomplishment. I want to thank and congratulate all of our associates for the work that they do. They are our differentiator and the key to our success. In closing, we're excited about the strength of the business model and the opportunities that lie ahead to grow sales and earnings. We are proud to offer customers the ability to progress seamlessly through and across online and in-store channels, delivering what our research affirms is the most customer-centric buying and selling experience. This competitive advantage gives us access to the largest total addressable market in the used car space and provides a strong runway for future growth. With that, we'll be happy to take your questions. Madison?
Thank you. And at this time, if you would like to ask a question, please press the star and 1 on your telephone keypad. You may remove yourself from the queue at any time by pressing star 2. In the interest of time, we ask that you limit your questions to 1 at a time. Once again, that is star and 1 to ask a question. And your first question comes from the line of Sharon Zackfia with William Blair. Your line is open. You may now ask your question.
Hi, good morning. I guess, good morning. As we think about fiscal 25 and kind of that tale of two halves where there were some share losses in the first half followed by the accelerating gains in the second half, as you kind of diagnose that, can you give us some insight into kind of what you think the drivers were between the first half and the second half and why you kind of saw that inflection? And I guess secondarily, as we're kind of staring down this idea of maybe used car prices going up again with tariffs, I mean, what lessons did you learn over the past several years that could maybe help the business more if affordability becomes more challenged again in the industry? Thank you.
Okay, Sharon. On the first question about kind of first half versus second half, look, the main driving factor that, and we talked about that at the beginning of the year, is we were coming off of, if you remember, last calendar year, that last quarter, there was a big price correction. Remember, it was the last and third one that we saw. And when you have those big price corrections, I think if I remember correctly, it was probably around $3,000 in a very short period of time of depreciation. That impacts us a little bit differently. So I think you had that kind of really worked into the fourth quarter that masked a lot of the things that were providing benefit for the rest of the year. If you think about the improvements, and I cited a lot of them on the call today, but I think there's just a lot of factors. We're continuing to make the experience better for the consumers and our associates. We've got better execution. You've got the benefit of efficiency gains and kind of flexibility that gives you both in your pricing and your margin, making sure that you're competitively priced. Our inventory acquisition expansion, we've continued to set new records with our Max offer. It just gives you a wider variety of inventory. And then I think the other thing is this year we've also just seen a more normal pricing environment. So I think there's a lot of things going on there, but I do think that the actions that we've taken are really what's driving the momentum, and I think they were masked a little bit in the first quarter because we were coming off of a big macro factor. As far as your second question goes, I think it was just kind of, if I remember correctly, it's what have we kind of learned? How are we better positioned now versus previous? And again, I think there's a lot of things that we learned in the last 2 or 3 years. One of them obviously is, we've sharpened our skills. When we came out of COVID, our 6 to 10-year-old cars just wasn't a big focus for us, as big a focus, and that's not really what customers were looking for. And so we had to build that muscle up. So we have more 6 to 10-year-old cars that, over time, I think other things, we've expanded the sourcing, which I just talked about. I think John spoke about the ABS bifurcation. If you remember, coming out of COVID, there's a lot of profitable loans out there, but we had to pass them on to lenders because we had one ABS that required a certain return and certain loss ratios. So, now having a second ABS, I think absolutely helps us preserve some of those sales. You like to think all of them get picked up, but some of them won't get picked up. So I think that's another one. You got the cost improvements that we've been focused on over the last couple of years. the work that John and his team have done on the FDS and making sure that we make it very easy for customers to understand their monthly payment and look for options that fit that monthly payment. So I think there's just a lot of great things, as well as just the overall Omni experience. We didn't slow down during the last few years. We kept plugging along at it because we knew this is where we wanted to get. So I think there's a lot that goes into that.
Thank you. And your next question comes from the line of Seth Basham with Wedbush Securities. Your line is open.
Thanks a lot, and good morning. Bill, if you wouldn't mind commenting on quarter-to-date used comp trends, that would be great. And then as you think about this macro environment and the potential for new car tariffs driving double-digit increases in new car prices, what does that mean for you guys from a share gain perspective and from a used car industry growth perspective? Thank you.
Yeah, good morning, Seth. On the comp trends, look, if I look at the fourth quarter, December and January were very strong. February was a little softer, which we expected given that we had leap day last year. We also think February was slightly impacted by the delay of refunds. And what I mean by there is, if you remember, probably halfway through February, refunds were off significantly year over year. Now, they caught up pretty much by the end of February, but I think it pushed a little bit into March, as well as we had some weather impacts. Then we get into March, and we saw a step up that was a little stronger than the fourth quarter comp, and it continued the whole month until the end of March, where we saw some strength, some additional strength, which continued and then accelerated into the first few days of April, which obviously we're early into April right now. From a comp standpoint, first quarter to date, we're running high single digits. Your second question, I think it was on tariffs. Is that correct?
Yeah, new car tariffs, if they drive double-digit increases in new car prices, what does that mean for the used car industry and your ability to gain market share in that environment?
Yeah, I think there's a lot of moving pieces here, and I'm sure it's probably changed even while we've been on this call, but there's a lot to watch. You want to look at the new car pricing, the supply, parts costs, used vehicle supply, just market volatility in general with consumer sentiment. Obviously, as you pointed out, new car prices are definitely going to go up. I think, certainly as new car prices go up, that'll put a bigger spread between late model used and new cars. So obviously just the speculation of the tariffs and now the tariffs actually being out there, it's driven demand. I mean, you're seeing it in the franchise dealers. We're seeing it just based off of the step up that I just spoke to. I think it will push some folks into looking at used cars, late model used cars, which is interesting because that's what we're seeing a lot of interest in right now. Now, I think over time, what could happen is that the used car prices will also go up. Now, the question is how much will they go up over what period of time? I think the other thing to think about on the tariffs that impacts our business, as well as anybody that sells used cars, is just the parts piece. When it comes to reconditioning, the parts will be going up, and it just makes our work that much more important on the efficiencies that we're going after on cost of goods sold to offset those increases.
Thank you very much.
Yep.
Thank you. And your next question comes from the line of John Murphy with Bank of America. Please go ahead.
Good morning, guys. I love hearing about the investment in the recon centers and the auctions because it gives you more throughput and production capacity. I'm just curious, Bill, as you think about that, does that give you the ability to stay and maintain this presence in the 6 to 10-year-old sort of car segment of the car population, and could that actually be increased over time? And sort of kind of along that same line, you talk about the 200 in COGS savings going to, it sounds like now 250. How much of that do you think you're going to be able to maintain as you kind of go through the reconditioning and other efficiencies? And is 23 to 2400 the new 2200?
Okay. Good morning, John. So on the reconditioning and the auctions, yeah, look, we're thrilled. I mean, that's going to give us additional capacity, which is why you're seeing that we open up more. Certainly, we want to have the cars out on the lot. We sell 0 to 10-year-old cars. We want to have what the consumers are looking for. And if they're looking for 6 to 10, we're certainly going to continue to try to move that mix without sacrificing the quality. I mean, that's something that you and we've talked about in the past, is we don't want to push cars out there to meet an age parameter that don't meet our quality standards. Because quite honestly, we're fine with taking those cars and wholesaling them. And we don't get the retail market share for them, but it's a great business when you're turning an $8,000 car, making $1,000 every 7 days. So interestingly, if I look at the sales mix this last quarter, we actually sold a little bit more 0 to 4 cars than we did older cars. That's not to say we're not pushing on the older cars and putting out those at the consumers. It's just an interesting anecdote that actually the consumers are looking a little bit more for the younger cars this quarter. I think on the $250 efficiency that we're going after, look, I think the big wild card there is just how much tariffs end up impacting parts. I feel great about the fact that we're getting these efficiencies across the system, in old stores, in old production centers, in new stores. So I feel good about getting those. Then the question becomes, how much will tariffs kind of offset that? Which again, we're going to continue to focus and go after that. The other thing I would tell you on these reconditioning centers, these offsite reconditioning centers,